In 1998, a hedge fund called Long-Term Capital Management had two Nobel Prize winners on its board. Brilliant men, decorated men. Men who had literally rewritten the mathematics of financial risk. And they blew up. Not slowly, not painfully over years in 8 weeks. They lost $4 billion and nearly took the global financial system down with them. Now here's what nobody talks about when they tell that story. It was not their strategy that killed them. Their models were correct. Their logic was sound, their edge was real. What destroyed them was size. They had borrowed $30 for every $1 they actually owned. And when the market moved against them, even slightly, there was no room left to breathe. No room to wait. No room to be right later. They were finished before the story even began. I want to tell you something that took most successful traders years, sometimes decades, to truly understand. The secret to making money in the markets is not finding the perfect strategy. It is not reading charts better than everyone else. It is not being smarter, faster, or more disciplined than the next person. The secret, the one thing that separates traders who are still here 5 years later from those who burned out in 6 months, is this. How much you risk on each trade determines whether your mind can function properly. That is it. Not what you risk, how much. And once you understand that, everything changes. Think about the last time you had a genuinely stressful day at work. A difficult conversation with your boss, a presentation that went wrong, a deadline you almost missed. On a day like that, could you solve a complex math problem? Could you make a nuanced, calm decision about a difficult situation? Could you follow a carefully constructed plan without deviation? Probably not. Because stress does not just feel bad. It physiologically reduces your ability to think. Your brain, when it detects a threat, shifts resources away from the prefrontal cortex, the thinking, planning, rule-following part, and floods the body with cortisol and adrenaline. Fight, flight, survive. This is beautiful engineering for running from predators. It is catastrophic engineering for trading financial markets. And here is the cruel irony that most people never see. The moment you put too much money at risk on a single trade, your brain classifies a losing position as a predator. Not metaphorically, neurologically. Your body responds to a 2% loss, the same way your ancestors responded to a lion in the grass. The heart rate climbs, the vision narrows, the rational mind steps aside. And now you are not a trader anymore. You are a survivor, making survival decisions with market money. Let me walk you through exactly what this looks like, because you've probably lived it without having words for it. You see a set-up clean textbook, everything your system is looking for. But the position size you are considering is significant, meaningful, big enough to matter. So you hesitate. You wait for one more confirmation, one more candle, one more signal that feels safer. And while you wait, the trade works without you. Now you are frustrated. You promise yourself, next time, I will pull the trigger. So next time you enter, but you enter late chasing the move and you get stopped out at a small loss. Now you are angry. So the next trade, you move the stop just a little, just to give it room to breathe. You tell yourself it is because you believe in the setup. But that is not why. You move the stop because the loss was too painful to accept. And so a small, manageable mistake becomes a large, damaging one. This is the cycle. This is where accounts go to die. Not in one catastrophic moment, but in 100 small decisions corrupted by fear, wearing the mask of logic. Now I want you to imagine a different version of the same scenario. Same chart, same setup, same market. But this time, the position size is small enough that if this trade goes completely wrong and hits your stop, you barely feel it. It is the cost of one dinner out. It is inconsequential. What happens to your decision making? Everything changes. You enter without hesitation, because hesitating costs you nothing. You honor your stop without argument, because the loss does not threaten you. You let the winner run, because there is no desperate urgency to lock in a fragile profit. And the whole experience, from entry to exit, is almost boring. Boring. That word is going to come up again. Remember it. Morgan Housel wrote something in The Psychology of Money that applies here perfectly. He said that the most important financial skill is not math or spreadsheets or knowing the right stocks to pick. It is the ability to keep playing. The ability to stick around long enough to let compounding work. Staying in the game that is the whole game. And the traders who stay in the game longest are not the ones who made the biggest bets. They are the ones who made bets small enough that their inevitable losses never ended the game for them. Let me give you a number that might surprise you. A trading strategy with a 60% win rate still loses 40 times out of every 100 trades. 40 losses per 100. If each of those losses is large, those 40 losses will emotionally destroy you long before the 60 winners have a chance to save you. But if each loss is small, a rounding error, a cost of doing business, those 40 losses barely register, and those 60 winners compound quietly into something real. I want to talk about ego for a moment. Because ego is the invisible force that makes every trader resistant to this idea. Trading small feels like defeat. It feels like you are not serious, like you're playing pretend, like real traders, confident traders, successful traders do not shrink from the market. Your ego wants significance. It wants to feel the weight of a big trade. It wants to be able to say, I put real money on the line. But here is what the ego does not understand. The market does not know how significant you feel. It does not know your account size. It does not know whether you are committed. It does not reward confidence. The market rewards execution. Clean, consistent, emotionless execution of a system that has an edge. And you cannot execute cleanly when your ego is in the room. The best traders I have observed, the ones who lasted decades, not months, had one thing in common that had nothing to do with their systems or their strategies. They had learned to make trading feel insignificant. One trade at a time, one setup at a time, no drama, no identity attached to the outcome. No need to be right about this particular position. Just the process, just the edge. Repeated, patiently, over time. Let Let me bring in a concept that most people associate with investing but applies just as powerfully to trading: compounding. When most people hear that word, they think of a dramatic curve, exponential growth, wealth doubling and doubling, the magic of time and returns. But compounding has a silent enemy that nobody talks about: blow up. If you earn 30% this year and lose 40% next year, you are not down 10%, you are down 22%, because losses erase more than their equivalent in gains. This is why consistent small gains, boring, unremarkable, barely worth bragging about gains, consistently beat spectacular runs followed by spectacular collapses. The tortoise does not just win because it is steady. The tortoise wins because it never has a year where it loses 40%. Position size is what keeps you in the race. Position size is what prevents the one catastrophic trade that resets everything you built. And in trading, you only need to make that catastrophic mistake once. I want to give you something practical here, a refrain you can actually use. Most traders measure their success by profit, by whether this week was green or red, by whether this trade worked. But I want to suggest a completely different scorecard. Ask yourself, after every trade, did I enter according to my rules? Did I honor my stop? Did I manage the position the way my system says to? If the answer is yes, the trade was a success, even if it lost money. And if the answer is no, if you hesitated, moved the stop, cut the winner early, held the loser too long, the trade was a failure, even if it made money. Because money made through poor execution is not an achievement. It is luck. And luck does not compound, process does. When you shift to measuring execution instead of outcomes, something remarkable happens. You stop caring whether each trade wins. You start caring whether you traded well. And when you trade well consistently, the outcomes take care of themselves. There is a word I have been saving for this moment: durability. The traders who make it, who are genuinely successful over years and decades, are not the most exciting traders. They are not the ones with the best single trade stories. They are not the ones who doubled their account in a month. They are the ones who are still here, still calm, still consistent, still executing the same system they built 3 years ago. Durable. And durability is not a talent. It is not a gift. It is not intelligence or market intuition. Durability is the result of trading at a size that does not burn you. Because trading is not a sprint. It is not even a marathon. It is more like farming. Seasons of patience, seasons of preparation, and the understanding that you cannot force the harvest. You can only create the conditions where growth is possible. And position size is the most important condition of all. So, here is where I want to leave you. Not with a checklist, not with a magic formula for how many % of your account to risk per trade, with a question. What size would allow you to take every valid trade your system generates without hesitation? What size would let you honor every stop without negotiation? What size would let you wake up tomorrow after a losing day and feel completely ready to execute again? That size, wherever it is for you, is your real trading size. Not the size that feels impressive. Not the size that could change your account in one trade. The size that protects your most important trading asset, your mind. Long-term capital management had Nobel laureates. They had the best models money could buy. They had genius on their side. And they still lost $4 billion in 8 weeks. Not because they were wrong, because they were right. With a size their system could not survive. Your edge only works if you are still here to use it. Trade small enough to stay, and let time do the rest. That is the truth about position size. And it is the truth that will change everything if you let it.